Welcome to Trading Nation. I'm Dominic Chu. We're joined by Tom Lee of Fundstrat Global Advisors. And Tom, I want to say this is an interesting segment here because you've noticed a disconnect between corporate profits, the earnings picture, and the stock performance in the market overall. What exactly are you seeing, and why is this divergence so important?
Hey, Dominic. Yeah, what we've noticed, and we're in the middle of earnings season, so we thought it'd be good to take a look, is that the sectors that have contributed to the earnings growth in Q1, and S&P earnings are up 11%, it's really driven by 5 sectors. Of those sectors, only FANG and technology are outperforming the market.
All right, so we already understand that maybe the comparables over last first quarter, the same time last year, they're fairly easy to beat. But it still sounds as though there's at least robust earnings growth, 11% like you said. But if it's only technology, there's a reason why technology is the most important sector out there. It's the most heavily weighted. So maybe it's okay that technology is doing some of the heavy lifting, or not.
Yeah, actually, I think that's right, Dominic. I think technology and FANG, because we've in our work started to strip FANG out of both technology and discretionary. They're important. It's an important sector because one, it really addresses the tightening labor markets and the need for automation. And so I think just like the 50s, technology should be doing well because I think there is going to be secular demand for tech spend, and FANG makes a lot of sense because in this market where the PMIs are showing slight downside risk, FANG represents really scarce growth in this market.
So as we take a look at basically this mega cap picture for technology stocks / discretionary, because like you said, Amazon is technically a discretionary stock. Generally, it's been fairly okay for earnings so far with Netflix, Amazon. I mean, the Facebook component is going to be intriguing to me because we're talking about Facebook and Apple as the two of the big headliners for technology earnings this coming week. So as we talk about the way that this divergence is performing, why is it that it's so troubling to you to see this kind of earnings growth versus stock performance gap, if you will?
Well, Dominic, the disconnect in our view isn't necessarily that FANG and tech are outperforming. It's just that banks have been big earnings contributors, energy and basic materials. Those other three have done as much, or if not even more, to grow S&P earnings in both Q1 and 2017. And these groups are underperforming the market year to date. So we think the disconnect is that the market is correctly paying for FANG and for tech. And as you know, category killers and really important companies like Apple and Facebook, it makes sense they should lead. But we think that you should also be seeing a recovery in the groups that are driving earnings, which are down year to date.
So this could mean one of maybe a couple of main things going forward. One is that those sectors that are underperforming try to catch up to the earnings growth that they are contributing to the overall market. Or the other is that the stocks fall, right, because they aren't contributing as much and maybe the earnings growth isn't really there to power enough of the stock gains. So in your opinion, which one is it? Are we going to see those sectors that have been at least showing signs of earnings growth move up and catch up to the rest of the overall market? I cite energy specifically because we know how bad. It was almost the trough for earnings first quarter last time around.
That's right. I'd say we're in the camp that the catch-up trade is for the laggards like energy and the banks to catch up to the broader market. Energy in particular has been a tough call. Part of it is that there's still not a lot of conviction about where oil prices are, and it's reflected in the fact that the market's still in contango. But energy credit, both in CDS, investment grade, and in high yield, have been the huge performers this year. So we think one of the disconnects is that energy, high yield, and CDS reflects the recovery in energy profits, but energy stocks don't.
All right, so perhaps the stocks catch up to what the bond markets are already showing in terms of health of the overall energy sector. One more point overall for this earnings season. You mentioned that 11% earnings growth number. That's what we're forecasting if all other reports for the S&P 500 come in as expected. Are there any things that you see possibly derailing the whole story for stocks right now? We know there's a lot of skepticism. People have been waiting for this pullback that just never seems to happen. Is there something that you keep an eye on that says maybe if these things happen, we would be a little bit more worried about the overall market?
Yeah, well, Dominic, we're in the camp that we do, we're pretty cautious on the market overall, but we don't think earnings is the reason to be bearish. I think that there is this turn in earnings that started last year. I think it's really being driven by more global dynamics. I think you guys have actually noted this. Non-U.S. revenue has been highly correlated with stock price performance this year as well, and the PMIs globally are doing well. So I think that the cadence of earnings still should be pretty positive. For us, it's just the divergence between credit markets and bond markets and equities.
All right, so if we take a look at that, somebody's going to have it right. Maybe it's stocks, maybe it's bonds, but certainly something, Tom Lee, to focus on. Thank you so much for joining us, Tom Lee of Fundstrat Global Advisors. And thanks for joining Trading Nation. I'm Dominic Chu. For more, go to tradingnation.cnbc.com if you missed any of these segments and other ones in the past as well. Until then, we'll see you next time around.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.